You ready?
I am.
Cool. Let's just kick it off. I'm sure we'll have a few more people pop in. Um, well, everybody who's new here, welcome. I see Jeremy and a couple people that I recognize, so appreciate you guys coming back. My name is Matthew Gullo, and I'm the host slash creator of the HIT Houston Investment Team organization. Essentially, we just created ourselves to reach out to people and kind of let them know it's a vehicle to let people know how to invest without anybody selling anything. We don't allow any pitching or any sales gimmicks. We're not gurus. It's really just informational. And obviously, if you have any questions, we're here to help. I am a real estate agent here in Houston. I've also I grew up here in Houston, and so I know a lot about the city. And just super excited to have Aldo here with us. We go back quite a number of years. I think it's almost 15 years ago. We were neighbors in the same neighborhood, and we lost touch with each other for a few years when he moved out, and then reconnected over a large multifamily property. And I remember him and his partner Pablo talking about investing in single family homes and things like that. And so Aldo's really just a great friend and somebody I look up to as well. We're just grateful to have him. So I'm going to let him go ahead and kick it off and give you a little bit of background on his education and how they got started in real estate, and wow us with what they're doing now.
All right, thank Matt. Well, first of all, I'm gonna say that a lot of people and even in the description is like, okay, I'm gonna make a very quick clarification. I'm not a real estate expert. I'm an experienced investor, which is a very big difference, right? I mean, expert. There's a lot of people that grows to a level where all they do is to sell something and do these speeches. And I think most of what I do in the podcast that we just started and the True Investment and any of the other ways is just to tell you guys about our experience, which is pretty hard to get at some point. And without a doubt, I mean, we have maybe people that ask me a question maybe once or twice a day, specifically for real estate, and particularly because it's not my full-time job, which is something that it's a little bit against the common sense, I'm going to say, or the norm that you're taught at school, So if you want to be something good at this, you got to dedicate full time to your job. There's got to be your profession. And I think that's where most of my background comes from the experience of getting it done. And so thanks for the invitation. I really want to keep it super informal. So if there's any questions, just send them over to Matt. He ask him and we'll stop. But on the agenda, what I would like to basically touch is why did I get started in real estate, and when. Simple why. I look at the way I did things, and then give you guys a few. I wrote down 5 different takeaways that you guys can either follow or continue to investigate and to do so to start in real estate or grow your portfolio. Currently, to give you guys an idea on our portfolio, we have over 160 doors. We have 3 small apartment complex, and the rest are basically duplexes and single families. We have gotten away from single families because we don't want it anymore, because it's the market is tough. But our bread and butter are duplexes in the Houston area, and I'll describe a little bit what the portfolio looks like. And if you guys want to have an idea while you guys are listening, if you guys go to www.freedompathrealty.com, that's our website. It's when I say we, it's my friend, my best friend and business partner Pablo and I. We started 12 years ago, and that's our current portfolio. So if you go to vacancies, you can see the details of what kind of properties we own. You guys also can see the details on the pricing range. And then if you go to the portfolio, then you can see the list of all the properties. And if you Google or on the same vacancy part, you can see the map so that you guys can see where they're located at. So I'm going to start by saying the only reason why we got into real estate is because we wanted to get out of the rat race to some degree. And for those that are not familiarized with what the rat race is kind of like the typical arrangement on a lifestyle where people teaches you go in, get a job, 8 to 5, make money, and then spend the money and then continue to do so. And then you make, the more money you make, the more money you spend, the more money you spend, then the more money you need, and then continue to do so. And Pablo and I, on one drunken night or so, we started to say, well, is this truly what we want? Pablo is, he came from Colombia too. He was born, raised, and I was born and raised in Mexico. So we migrate to the US and we had good jobs, and we said, is that truly what we want? And we started to question it, right? So on that search, we look for different answers. And of course, there's multiple venues on how to get there. But philosophically, the idea was we got to the conclusion that just like many true experts in real estate say, it's all about passive income and leveraging. Having a good job is good. It's good for the today, and it's good for the planning, but it's not truly too ambitious on the retirement side. You can start your 401k, you can start your different venues, but you most of them, you have to work for them for a long period of time before you can capitalize. So we concluded that obviously real estate was a very good option. And then as we started, I came up with from a family that was pretty entrepreneur. So that was a little bit counterintuitive, because the first reaction or the first option I had is like, let's start a business. But unfortunately, I had a very good job. So, I mean, yeah, you can start a business and quit your very good job, but then you got to do this, right? And that's where we kind of started to question, is it really another active, non-passive investment what is good for me? And we had two different routes to do this. The first one was to do it the formal way, which was go get educated, go and get training, pay for that training, pay for that coaching, go and start to get all those their communication from that network, and build around that our investment portfolio. Or informally, basically just go and ask a friend, do a passive investor for a while. And we looked back and forth. And at that time, I had a very good job, so I was traveling a lot. And the easiest way for us to do it was focusing on getting trained. So we started our career on real estate. It started in Lifestyles Unlimited. And it was truly an advertised move. It was literally on the radio, come to this seminary, pay for it, get trained, and then get started kind of deal. And we paid over $400 or $500 for that first weekend. We went in, we got trained, we liked it, and we started from there. We did started with our personal finances, which it's extremely important, and I'll talk a little bit more in detail. And I touched on that on one of the first episodes of the podcast, because the one of the key parts is no matter how smart you think you are, or how educated you are, no matter if you have a big master's degree or a couple degrees or something, there are some personal finances that takes a while to mature too. And particularly with people with professional careers that have a normal growth, where you start making just enough money to pay your bills and then to pay your debt, and then and then to start accumulating a little bit of savings, no one really gives you anything. And the first option is put more into the 401k or go to a financial planner. In so that was the first step that we took. I mean, we got educated, we started to get trained, we invested. Obviously, it costs money to get trained, and then we started from there. And at that time, it was learning everything from what kind of loans can you get, leveraging your credit score, of course, how to modify to increase your credit score, how many banks can you work at the same time, what kind of properties can you afford, and then start looking for that. And it, it's the why never change. And I think the true the reality, and this is pretty good because I'm sure most of you guys have careers that are similar or into real estate. That's what you guys are calling in. But let's say we took, like Pablo and I took completely different paths. I have 3 kids. Pablo has no kids. We're exactly the same age. We're a week apart. We're about to turn 41. And Pablo basically retired, semi-retired 3 years ago, where our why of the passive investment was there's only 2 ways to virtually retire. Either you make more money or spend less money, right? And or a combination of both, and you can get there sooner. So the why, it's always been there. It's a passive investment. Now I want to clarify something. Passive income, I'm sorry. And the I want to clarify something. The passive part, in anyone that looks on how to buy my first house or go to TikTok or go to Instagram and looks for how to get a investment property, when we talk about passive income, it takes a while to be passive. And that's something that no one really tells you very often. But in reality, the first maybe 5 years is a struggle. Maybe the first 10 homes are the struggle, because no matter what good of a businessman you are, and the learning curve is still there. Anyone that can tell you that they're getting to the 500, 1,000 doors, or that they are close to 15, 20 properties, and if they are owning and managing themselves to have a decent return, the first 3 to 5 years, there's nothing passive about it. And again, I've read a lot about it. So, I mean, we've been going back and forth with the podcast a lot on this. And when we talk passive, a lot of people think, well, I'm just going to put my money and I sit back and kick back and it's a great investment. There's some grade line in there. You can get there. And I'm sure you get there. People that have, I don't know, 300 units, eventually they could just say, I'm not going to do anything and still live in with a very good passive income. But it takes time. So, but the why, I think,
Well,
always remain the same, right?
yeah. I think I was going to interject there, and I think one of the things about the whole passive thing is that it's passive in the sense that you may not have to touch it every single day like you do a job, right? A job, you're getting up 9 to 5 or 8 to 6 or whatever, and you kind of have to be there, whether you created the job for yourself as a self-employed person and you're running a team, or whether you go to a job, where there's someone else that you're working for. You're kind of there, all the time, or at least obviously the kind of the norm, 40 hours a week. And so I think, with the investing, I think you're right. People think, oh, it's just passive. I gave my money to Aldo. He bought a 20-unit multifamily and I don't have to do anything. And if you are truly passive like that as an outside investor, maybe. But the way that you've done it, it's, sometimes you almost have to take off work 2 or 3 days to go back and do, sort of your second job, or get back into the real estate thing, whatever, to evaluate a deal, to meet with a contractor who's going to renovate something. You're not
Right.
going over there with a plunger and some tools and fixing the toilet per se. But you might have to go check on somebody that did, to make sure it got done correctly, or you got to hire somebody that made sure it was done correctly.
Right, right. No, very well said. And um, the goal in mind, though, and I read this recently. They said that like 85% of the real estate investors fail, and I don't know if it is true. I really don't, and I really would challenge to say what is a failure in that is statistics, right? I mean, is it because they didn't continue to do investments? Is it because they didn't get the returns they expected, or is it because they lost money? I don't know exactly what that data came from, but um, the why on the investment side is critical. I mean, uh, the passive thinking that having a $30,000 a year, maybe 40, maybe 50,000. Talking realistically, I'm talking about Texas, right? In Houston, particularly. Uh, Having that, I mean, that's a huge amount of income. If you don't have to quit your job, or you don't have to actually work 8 to 5 to get that amount of money, that's significant amount of income, right? Now, if you can multiply, that's pretty good to me. So for the starting people and the people that are focusing on saying, how do I get started on something, the why is critical. I don't think it needs to be. The first mistake I see a lot of investors doing is, I want to invest in real estate. Why? And there's two answers that just almost drive me nuts. The first one is because I don't have anything else to do. So this is not a hobby, truly. I mean, once you get into it, I mean, it's stressful all the way around to start when you start. And the second one is because the market is hot. I mean, because I read and I heard that I can make money. Well, I mean, those two answers kind of drive me nuts because, yeah, there's some fluctuations in the market that could help on the business, but still, I mean, the why needs to be, in my point of view, it's got to be because my options to grow my my revenue and my income, I want them to be passive because I don't want to have to take a huge amount of risk. I don't want to change careers because I have enough. My risk sensitivity is such that justifies my investment in real estate, and that's it. If that is a true drive for why you want to invest in real estate, I think it's a good get go. Now the the other part obviously is when, and I'm gonna kind of jumping here. A lot of people expect and they start reading and said, oh, let me look what they uh, I don't know if you guys see this, but everyone wants to kind of like manage business today like they do like the stock market. Oh, let me look at the graphs and let me see how they intersect and so on. And what I was taught, and I really agree, and I've seen it, is there's always a good time to invest. Now you adjust to what kind of properties you buy, and you adjust of either um, buy to rent or buy to flip or buy to resell or buy to hold. But there's always a good time. If the houses are expensive like they are right now in Texas, well, then you buy to rent high because eventually those houses are gonna be unaffordable and people are gonna start renting more. And now, if you buy a flip, then it means that you have more money to be make, so you can go and try the first flip or second flip. Now, if the houses are starting to deplete, well, you better have money to start buying, right? So there is always just the hard part to talk about this on when is you have to talk to the true professionals, like the lenders, the realtors, people that have a bunch of data that can go and tell you, yeah, the assumptions that you're making today on these transactions are valid. And and when I said true professionals, I mean uh, the 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 people that are doing 3 or 4 transactions and analysis a day, the people that are doing closings every other week, the title companies, the brokers. I mean, people that are willing to help you to give you that information because otherwise you're taking one point on all this spread and said, I'm assuming that this is going to be a good deal. Well, I never trusted. I have over 150 units, and I never go in and said what I believe is the right. I mean, I go and ask the lender, and I go, hey, you think it's going to price? I just asked Matt, I mean, a few minutes ago before you guys joined us, I was like, are the houses appraising? I'm not closing 3 or 4 houses like this guy is a month, you know. He's putting offers every other day. I'm not. So there's never a bad time to get good consulting, you know, of professionals on their field. So I think that is pretty. It could be a little cliche when I say when. Well, it's always a good time. You're never too late. You know, all those phrases. But I really believe it. I mean, I really believe that if they're high, there's money to be made. If they're low, there's money to be made. How to leverage and what kind of properties you got to look for, big deal. I mean, that is what you have to focus on, not if you need to jump on today or not. Um, then I'm gonna go with the how, to make it very simplistic. I really don't think anyone can tell you specifically how, but I do believe that at least what it worked for us is to get educated. I really think that paying by getting support by professionals, uh, and to put it in a very simple analogy, I met a lot of people that wants to buy houses without a realtor, and because they think that they can save a percent or two, right? I said, well, that's wrong. And I know you guys realtors are gonna be like, yeah, but I do agree. I mean, I seriously, I could write the contract myself. It doesn't matter. I mean, I have enough experience. So, but why would I? I mean, this guy's is licensed. They're trained. They're up to speed with everyday stuff. Like, if anything changes, why would I be the one missing and paying for it? I mean, I just like a good plumber or any professional. I mean, you don't want to have problems out the line on the decision that it's important to you. Um, so I did that from the beginning. I was able to say, I gotta invest, I gotta get educated, I gotta, and when you get it, when you started to get educated and pay for someone to tell you how to do it, what I find out is that uh, uh, there's a lot of stuff that I believed it could be seen as a common sense, and there's nothing. There, the majority of this stuff is not common sense at all. I mean, this is just checklist. These are yes or no that people do every day. There's no reason why you would need to make an effort onto getting better at what you do if these people are already good at it. So um, things like I realized that there's a million of people that ask the same question: can I evict someone? Right? How hard is it to evict someone? How long does it take? Do I need a lawyer to write a leasing agreement? Do I need a realtor to do a leasing agreement? Um, is it a written possession? Very hard to do. How much does it cost? What is it going to happen with my insurance? Is it the insurance a replace value or not? And all these questions, I mean, I could spend 3 years Googling them. And maybe I would have learned half of what I did for the money I paid. And I paid very good money. Now, of course, it's hard to tell because with all this market of all these companies that they're experts on real estate, I mean, which one do you really believe? Which one is better? Which one is not? I don't know. I mean, I think
And you use
I can give.
lifestyles, is that right?
I did. And on a personal level, I can tell you that it's um, there's some reasoning of why we started and the way we started, but I wouldn't go all the way through the training program because there was a huge discrepancies in some other stuff that with years of experience now I saw that they were not the best at. But at the beginning, it was worth it. It was worth every penny, right? Now, one of the things that they do that is pretty critical is that at some point you're so vested onto the money that you're putting into that you say, well, I better do it now, right? I mean, I already paid this much. I already have this membership. I already have these deals. So I better go through it. And it's almost like paying a personal trainer, right? I put that as I mean, you're paying, then you wake up at 5 a.m. and go and train. Otherwise, you stay in bed. So
Yeah,
They do manage a lot like that.
Yeah. I mean, I've had a coach just about since I started. I did take a break maybe for a year, but at the end of the day, they give you good tips. They help shortcut the learning curve sometimes, not always, but sometimes, probably more often than not. Yeah, you gotta, sometimes you just gotta pay to play. I mean, there's not a single professional anything in this world that doesn't have a coach. You can't think for one second that a CEO of a massive company with 5,000 or 10,000 employees doesn't have 3 or 4 other people that he's probably paying $100,000 a year for advice, and he may get on a private jet and go fly and hang out with that person once or twice a year.
That's right.
And maybe not all of us can do that, but you got to have somebody. And then to further that, you've got to have friends. Like I know that I can call you and ask you a question, and that you can call me and ask a question. And that's so right. That's not necessarily a paid relationship, but it's something that's been built over a long time. And sometimes it might just be about fatherhood or something like that, but at least that's you have right. people in your corner that you can ask questions to. I don't know what you have next on your list, but I was going to maybe see if you could just tell them a little bit about how you got started, and maybe your first deal, and then that turned into 10 single families, and then you sold some of those, and then kind of jumped up into the bigger leagues.
Yeah. So we started with literally $5,000. And we did a little trick, which was Pablo and I and another friend of us that we started together. We had literally saved $5,000 each, and we're having comfortable lives, but we didn't know if we wanted to do it. And we put it in a savings account, and we said, this is going to be our season money. I think we rounded up to $20,000. And at that time in Houston market, it was 2009. We said we're going to leverage as much as we can, and we were probably putting 10 offers a week. We find like 5 different realtors, and we told them we qualified. Here's our pre-approval letter. Here's the $20,000, and we could share that savings account, right? And then each of us started with one single family home, and the market was 2,000 square foot, 1 stories, 3 2s, done. All day long in Houston. Anything rents from $1,100, $1,200, $1,300, depending on the area. And all the houses that we were looking at were maybe foreclosed, short sale, by owner, something around the $80,000. We would go make it ready. And we were old school. I mean, remember, this is 12 years ago. I mean, literally, we would follow all to the key lifestyles option. That's it. That's why it helped. We'll put the sign in the front as we're purchasing it. We wouldn't even started the rehab. We were putting the for rent sign, and we will write down every detail of the home. We went and got a Google phone number so that we wouldn't need to answer the call, and you can have for $5 a number or something. And so people would call and said, I'm calling for Lynn Breyer House. Press 1, right? And you press 1, and then it goes, this is a 322. Your qualification is to be this and that. And this is the rent. You need to make 3 months minimum income. You got to do this. You got to do that. You got to everything. 2 minutes of speech. And then said, if you're still interested, leave a message. Done. You filter like 90% of the calls that way, right? And at that time, that's when, I mean, the burst. I mean, I wish I would have more money, but we didn't. So, but we learned at that time. That's when they put the rule of the 10 single family homes. So you could own your primary residency and 4 more under the same qualifications, and then you could buy the 5th to the 10th, the 6th to the 10th, with the same qualifications of the primary home, except that you needed to have 6 months of liabilities on cash. So when we got to the sixth one, all of us, then we got another 20 grand and put it in the savings account. And then we showed all the liabilities together. And then we went at it. And we ended up doing, again, the BRRR method, right? I mean, we went in, we'll buy a house, rehab it, rent it, and then refinance. Some of the money was with hard money, some was with conventionals, and then we rehab it and take all the money out. I mean, one house particularly we bought with 500 bucks. So again, everyone that tells you that you're going to be a millionaire and you're going to be, it's not true, right? I mean, you're going to make maybe $100, $200 a month, right? But when you got it with 500 bucks, I mean, your return is huge, right? I mean, your percent wise, your return is really big. And something we did that helped us a lot, and for anyone to start with, we did have an agreement. First, the three friends of ours, we started by buying all individual homes. I got one, he got one. And then we figured out that we were competing over the same resources, because it's pretty hard to get a good contractor. It was pretty hard to get attention to the lender, to the realtor. The realtor would get a deal. Well, who do I give it to Pablo or Aldo, right? So what we ended up doing is a gentleman's partnership, where we said, hey, we're here fighting against the same thing. We want the same thing. Why don't we just go all together? And that helped, because it wasn't only the risk, but it was the decision process. If there was a deal sent to me, then I would feel a little bit of guilt to say, hey, Pablo, what do you think about this deal, right? If he didn't have access to it. But the opposite, if we're partners in this deal, is like, hey, I got this deal, what do you think? And then we learn very early that a lot of the decision process is relieved by sharing that risk and that reward. So what we did is grew from there. So we got our first maybe 10 or 15 homes. And then 2012 came in, and it was almost as bad as or good as is today, where prices went way back up. And we actually start selling the properties around 30% higher than what we had estimated in the first appraisal. And that's when we started to get into the market of the duplexes. Because instead of buying a $60 homes, now we could afford $150,000 duplexes.
Right.
But the duplexes to us are bread and butter. I mean, we can, right now, I think 60, 70%, if I take away the multifamilies, the duplexes are about 85%, 90% of our portfolio. So instead of buying a $120,000 home that you're going to have one family, one rehab, one risk, one loan, we bought a duplex for 180 grand, but we have two rents. So we have 1,400 square foot homes that rent for $1,300, $1,350. And if you do the math, and you guys can go to our website and look at the properties, almost one property rented, it's a break even. So our risk was reduced to almost nothing. And we love those duplexes. We just started to buy duplexes. So we sold chunks. In 2012, I mean, this was crazy. I mean, we got, I think about 70% of our single family portfolio was sold to equity groups. They would just come and buy big chunks, because our portfolio makes about 18 to 24% cash on cash. So the equity groups make, and I mean, their expectation rate is maybe 5 to 7. So they could buy our property at market price with the tenants in it, and still get their investors about 7% return. So we sold them all out and started to buy. That is about the time when we walk into the multifamily. And multifamily, the way I see it, there's three ways to do it. If any of you guys want to jump from single family to multifamily, the first one is passively. It's a very good way to do it, because you get access of all the house without putting a lot of risk, and your return is decent. So anyone that says, well, it's a lot of risk, I'm not going to spend $1 million and put $200,000-300,000 and then rehab and all. Well, you can be a passive investor and invest $100,000-200,000, and or maybe get a little pool and get 50. But the know-how that you get as passive investor is humongous. I mean, you get all the books, you get all the process, you get on the signing, you get on the training, you get on the decision, like everything that you want to learn is it's on a $6% a year return. That's pretty darn good, at least to me. That I had to pay to train for that. Otherwise, you get paid to get that 6%. So that's pretty good. So that's the first way to do it. I mean, just go to it.
Yeah, I
The
agree
second
with
one,
that.
the second one is get into small multifamily. Small, I mean lower than 30 units. There's a lot of them out there. The reason why I say it's transferable is when you move from single family to multifamily, um, apartment complex there are 18, 25, 30 max is it's almost like a property that you can manage without having a live-in manager, and that makes a whole different ballpark. You don't need a leasing agent. You don't need someone full-time. You don't need a maintenance crew in town. Like, you don't need to do all these amenities. It's basically, it's going to sound simplistic, a little bit underrating it, but it's almost like a huge duplex, right? I mean, a fourplex where, eh, I mean, they got a dishwasher issue just to call the same plumber that goes to a house. You don't need to have a full-time employee there.
Yeah.
And our first multifamily was with you, Matt, Isabella,
Yeah.
and we did pretty good in that, but it was 18 units, and in that we did everything. We left. It's right there on 59 and 288 where the two meet, and it was like a 1958 building, and we got it everything. We did electrical, plumbing, and all we left was the outside, the foundation, and the roof, so that we could get a grandfather the parking lot requirement. And we follow a little bit of the rule of thumb of um, uh, that we got when we were trained, which was you always want to be kind of like the above average quality and a little bit above the pricing as well, because you want good tenants. So across the street was a maybe 1980 a little complex, and next to it maybe a 1970s. So
Mm-hmm.
our building was the best of the block, and we were renting, to give you an idea, I think 700 square foot for 950, and the two twos that we had that we had converted, uh, we were renting, it was 975 square foot for $1,200, but we only had 18. So all we had to find, it's in the whole Houston metropolitan area, right? Surrounded by A and C class buildings, because across 59 you can get an A class.
Right.
But we were at 1,200 and people loved it because it was the best that was in that block, and people could walk to work, and people could do it, and we did pretty good. From there, then we grew to a 33 unit, but following the exactly same criteria. We never had a manager on site, something that we could manage ourselves. Then we grew to a 20 unit in Hempstead that was owned and operated by the same owner. We bought it from him, and then we split out to duplexes. And and I think our challenge currently, like most of you guys, is where to get those good deals, right? We have always bought with the premises that we make money on the buy and on the sell. So Isabella Apartments, which is the one I was describing, any others, we never wanted to hope the 59 would grow, or the UH is going to make another building, or we always try to make the decisions on what is worth today. And if we make money today, at least in Houston, we know we're going to make money later, So the the last thing I want to say on it is that the big decision that any investor needs to get to is, are you, do you want to manage it yourself? Are you going to get someone else to manage? And you get to a point where that decision is critical. um, if you want to get a property manager to get there, then your numbers need to work right. You gotta have a lot of trust in that company or those people. You gotta you gotta let them do what they do, and make sure that you make money. And you have that criteria that your fluctuations are going to be undependent on the value of the property. Um, our decision was probably made about 5 years ago, when we said, no, we're going to manage it ourselves. If we grow the portfolio, it's because we can manage it. Or some other our friends, investors, went to Orange, went to Baytown, went to Galveston, went all the way to Austin, went to other places because they said, I don't care. As long as I get my 5 to 8%, I'm good with that. That is a strategy, no question, that can make you money. And in our case, we decided to do it ourselves, and that has actually been pretty helpful with the banks, because the banks love to have uh, real estate investors that manage their own properties, because they know that they see the value of their operation, and they know how it's going to do there's just a lot of work to do. So
How are you
um,
managing that? I mean, you're a father of three boys, playing sports, and you got a beautiful wife, that you want to hang out with, and I feel like you do a pretty good job of hanging out with your friends, and um, you know, you also are running an engineering firm. So how does that, if you're managing 160 units, how are you doing that by yourself or with Pablo?
so you hit it on the nail. The first thing that you gotta do, if you wanna do, you're gonna have to have a good partner. I mean, I cannot just tell you how good of friendship, but also partnership Pablo and I have. I mean, we divided our set skills, and it's very simple. And I know it's, again, a little cliche on this, but he's good with the numbers. He talks to the banks, the insurance, the property manager. He looks at the accountants. He looks at the booking. He does all of that, is all he does. And all I do is the operations. So I take care of the rehab, make readies, um, the estimates for the construction, new construction, rehabs, everything that has to do with the construction is kind of like my field. So we develop our skill, and we trust each other to enough to. I mean, I don't look at the books. I don't look at the taxes for 11 years. I know he's much better than I am, and he manages the account, and he does everything he has to do. The same thing over here. He's never questioning me. Oh, did we change 10 ACs this year? Why do we do it? Can we get a better price? Can we do? He trusted I'm very capable of doing that, and our relationship grew through that. That doesn't mean that we challenge each other. I mean, he's a mechanical engineer. He's smart enough. I look at what he's doing and all, but we know who is better at what skill set.
Mm-hmm.
So that is key. And the other thing is, again, on the why, on the passive income, I have based my life on the balance of it. For example, my office is 2 miles from my house. I mean, I'm just not willing to give 45-minute commute or an hour commute. I mean, I have to work around that. If I want to spend time with my kids and take them to school, and then pick them up when they come back, I can go pick them up at school and be in my office in 5 minutes, right? And
Yeah.
I convinced my partners in Valcor that I could do it. Now, funny enough, even now they're practicing martial arts, and their school is three doors down from my office, right? I mean, I can literally walk, get them out of the school, and get here. I can go home from lunch if I'm going to have a long meeting. I get Flavia involved, right? Forever. I mean, hey, it's Saturday. I had an issue with the house. Let's go, and I make it part of the deal. Um, I had got him to get involved in rehabs, like my little kids when I started the River House, which is
Mm-hmm.
an investment we have for the Airbnb. I mean, they would go with me and start working with the bobcat and paint the wall and do some framing and they're playing as we doing it as it's even part of my job, right? So now I did learn not that from my dad again because he was an entrepreneur, he had his own business. So instead of saying, well, here's my family, here's my business, but there's some combination in there that they can see the work, but they can also enjoy it. And I think that's just something naturally that is going to happen. Um, the, the the part on the oil and gas that I'm still that is super critical as well because banks right now, or I mean probably always, they've always wanted to lend money to people that are good investors, but that do not depend on the investments. So you look at anyone, Cardone and Wesley and all these big investors, right? They still have to have their W-2s. They still have to qualify it other ways. You guys as realtors, you guys need to have, if you guys gonna walk into getting into investments, you guys need to keep up your jobs. If not, banks are a little bit more conservative and say, well, if you only depend on real estate, that's gonna be hard to do. So, and you're gonna have a good partner. Your wife, your kids, your friends. I mean, whomever they are, they all need to be good partners. I don't believe that I would have been able to do anything by myself, to be honest. I mean, it's got to be that network of support system that you create around it in order for it to be successful.
Yeah. What do you do if, when a tenant calls and says, hey, I got, my oven broke?
So that's very, when you ask me like how do you do it, there's one thing that we like literally change your mind and the way that helps us escalate, which was the use of tools. Maybe the first 5 years we did everything in Excel files. We had tenants, we had Word, and we had maybe Dropbox, which is a big deal back then, 10 years ago. Like, oh wow, we can share a file, Google Docs or whatever. Um, when we jumped maybe over 50 units, we used a tool called AppFolio, and that transformed everything that we did. Is the best tool we've ever imagined. I mean, that helps us to do absolutely everything, and it's super cheap as well. Um, and we manage the 150 people with one property, 160 units, one property manager, and one maintenance guy. And they all the maintenance calls get online. They get on the phone, like I said, a Google phone number. They call in, they get registered. We all get mails at the same time. Um, we get our responsibilities assigned. There's a button for emergencies. There's a button for maintenance. There's a button for leasing, and then we all get informed at exactly the same time. And then you work with it. If it's an emergency, we all respond at the same time, right? I mean, what happened? Is it a big leak coming through? Is it fire? Is it someone, police, fight, whatever? Then we react to it. Very few of them. Maybe I'm gonna say one every other month, maybe one every 3 months. Um, the maintenance call, they get recorded. There is a log. There is work. We prioritize. We get assigned to the vendors, and no problem. Every Monday, the property manager does. And then the only thing that takes away my time is when we are estimating new purchases of big rehabs. Those things take a lot of time. Those things are there's no um, shortcuts for that. I
Yeah.
mean, you have to get to it. I was telling you about a deal that we were trying to buy, which was 29 duplexes. It took us 4 days to inspect them. I mean, we had to go there, three of us, and we would go everything from the condenser outside all the way to the attic. For it was 29 duplexes, so it was 58 units. We walked every single one of them. We took pictures, we registered, we did a tally, we were doing it. I could have hired an inspector, right? But it's $600 a unit. So I would probably, if I would feel like the units were so run down that I couldn't determine, but the units was 2009 or 2007. So, I mean, the big items like electrical and plumbing and all that, that's something that you can see and get through. So it was more the statics that we were worried about, and roofing and doors and trims and water pipes and appliances and countertops and cabinets, things that are wear and tear, to see flooring, carpet. And I mean, those things, there's just no shortcut. I mean, you got to get to it. I mean, we get dirty, we get down and dirty, and we do it. And again, just a little bit on the passive, no passive. Spring break, we get to Orlando. The first morning we're there, they call me there's a fire in one of the apartments. There's nothing you can do. I mean, such is life. You deal with it the best you can. Do it on the phone. Everything is fine. Let's wait. 3 or 4 days later, we come back and get the problem solved. I mean, there's nothing different like any other business. So
yeah, you get them an issue and handle it.
Mm-hmm, mm-hmm.
Does anyone have any questions? If you want to post them in the chat box, I will read them, or you're welcome to unmute yourself and fire away.
Well, they ask you a question. Let me give you the 5 takeaways that I want to give you guys. And I think some of them I have already talked about. First one is you need good partners, just like in life, right? I mean, you need good partners at home. You need good partners at work. You need good partners on the subcontractors, on the realtors, all the way around. Good partners are key in this business. Again, there's never a better time. There's always a good time. You want to flip a home, you want to try Airbnb. I have a friend that it's in this call that is buying her first Airbnb soon. Go for it. I mean, it could have never been a better time, right? I mean, who would expect Airbnb didn't even exist 5 years ago, right? I mean, is it a good time? Yes. What kind of? Well, that's what you have to figure it out. So it's always a good time. You just have to work on it. Escalation. That's something I loved about real estate. You don't need to start with 100 units. You don't need to start with 10. You don't need to start with 5. You need to start with 1. I mean, you can try it. The learning, the transferable skills that you get by doing 1 deal or 2 deals are just transferable all the way. There is not a single thing. I can guarantee you that there's not a single thing that you will learn on an investment deal, on the real estate investment deal, that you're not going to learn skills that you're going to transfer, either for your own home, for your next rental, for your next car purchase, for your next loan with the banks, I mean, all the way along. I mean, just that escalation is incredible. Now you can do 1, 2, 3, 10. If you don't like it, well, big deal. Just sell them. You learned, you saved, you got all your finances organized at that time, as long as it takes you, and then move on. I mean, that is something that I loved. And the other thing is leverage. Banks are lending money like crazy right now. I mean, it's not only the rate, the 3%, but it's just that in this country, it's just the economy works by keeping it active. There's nothing good about saving money right now. Nothing. And it's gonna sound stupid, but I mean, you could save all your money and put it in GameStop and lose it next day. So I don't know. I mean, I know it sounds pretty I'm gonna say marketable. It's always everywhere, but it is true. I mean, we live in a society that is just to keep all the investment going, and so that leverage with the banks right now is crazy. I mean, it's back to like 2012. I mean, it's almost like back to 2005 to 7, where I mean, almost you can buy money with 80/20s again and buy money with nothing.
Yeah, we have. I've got a guy right now. He's literally buying a house, and he's not putting a single penny down.
Yeah, and at 3%, I'm sure he's gonna be pretty
Yeah,
happy.
he's at 3 1/8. He's not putting any down payment down. I mean, he'll have his closing cost and funding his escrow account, and that's it.
Yeah. Yeah.
So he's
Hey, Aldo,
he's probably buying a house for $5,000 or less.
Aldo, I have a question for you. And firstly, thank you for hopping on and sharing all this insight. I've been taking notes on this, and there's been some incredible handful of incredible gems that you've said throughout this. So thank you for your time this evening. So my question, it pertains to like what we're talking about here with the financing and like velocity of capital with the lenders that you've worked with for purchasing these multifamily properties. Is it most of these lenders requiring 20% down, or have you worked deals where you're able to put 10 or 15% down in certain scenarios?
No, so most of them for multifamily are requesting 20 to 25, but they are very open to self-manage the construction part of the loan. And are you thinking on doing the rehab yourself, or are you thinking on subcontracting it?
So I would be contracting it out.
Okay, because what the banks, particularly in multifamily, they have a very broad leeway on what the cost estimate for the rehab is. And what we have negotiated with banks, and I can recommend you a couple, but I mean, like right now we're working with the Bancorp South, is you can do, let's say that you're buying $1 million property, 20, 30 unit. You can estimate your rehab and add your property management and your construction management fee on top of it, and put it onto the cost of the rehab estimate, and they lend you 80% of the after repair value. And the beauty about multifamily compared to single family is that approval comes before the appraisal. So if you are rehabbing $1 million property and you say that, let's say that your contractor gives you a $200,000 rehab budget, you can go to the banks with the 1.4, and they tell you yes or no before you buy the property. So at that time, they're gonna let me do the math here, but they're gonna lend you 80% of the 1.4 million, and you're gonna end up putting $80,000 down, which is way less than the 10% that you might want to be in. Does that make sense? What I'm saying?
It does, absolutely. Cool. Thank you for that.
No problem. And we've done it multiple times. Multifamily is a beauty on that. It's a little bit different than single family, because single family you have to get in with a very broad estimate, but it has to appraised. And if it doesn't appraise, then they lend you up to that value. So they will always tell you 75% after repair value, 80% of the loan value, right? So for multifamily, they're gonna give you that 80% before you closing the deal. So you're pretty good. You're pretty set on that, as long as you do it right. If you said that you're gonna change 10 ACs, go and change the 10 ACs. But it's pretty subjective. For example, how much do you pay for painting a unit? Or painting a unit, you could pay $3 a square foot, or you can pay $8, and that's still a reasonable price. So you can bear part of your cost onto that loan.
And I'm curious, are you only buying multifamily now, or are there situations where you're picking up single families if the numbers make sense?
No, we're always buying anything that makes sense. Single families is good to us. And one thing that we have done recently is we've been buying single family homes and converting them to duplex, which is a no-brainer. We bought Go ahead. I'm sorry.
Yeah, I'm curious about the parameters of that. Are you like basing that off of square footage? Can you walk us through that?
Yeah, sure. So In here, anything around the 1,400 square foot rents for close to $1 square foot. If you're below that, for sure you're gonna rent it. So when you get a property that is a single family home, let's say anywhere from 25 to 3,000 square foot, means that you can split it. In all you need to make sure, everything that you need to make sure is that the city where you're buying it from, it's allowing the zoning for the single to the duplex is allowable. And we have done 4 of them already. We buy a 3,000 square foot, let's say Baytown, pretty big zone. We have 2 entrances, and we modify the layout completely. I mean, we put 2 kitchens, 2 laundries, and we leave 3. Keep that in mind. I think Houston is just basic. 322s, anywhere between 1,500 to 2,000 square foot, and you're gonna rent it. So if that duplex to you leaves you around the 1,400, 1,200 square foot per unit, you can always rent it for about $1 a square foot. And your return on those units right now is close to the 20-25% ROI on cash.
To kind of rewind for a second, for the actual zoning, how do you go about verifying that?
Just call the city. And I said, I have a property that I am getting a construction permit for. And then they're going to ask you, what are you going to do? And I said, I'm going to convert it to a duplex. And they said, oh, you can't. That's it. It's a 5-minute call.
Okay, simple as that. Interesting. And are you setting up separate water and electrical meters for these properties, or do you just keep it all on one if it's a duplex?
No, I split everything. Water is not a big deal. If the budget is tight to make that deal work, you can always put a smart meter, keep 2 meters, but the city gives you 1 bill and then you split based on the consumption. Electrical, my recommendation, always split it. Always get a second meter. And now remember, on these conversions, you want to make sure that your electrician runs the electrical correctly, and you explain the layout before. And these layouts that I do, we use a $40 software. You can do it in a SketchUp. You don't have to be pro on anything. I mean, you can just drag walls and put it there, but at least just make a good split. And you can tell the electrician how much to run 1 box to here, 1 breaker box to here, and 1 breaker box to here. And that's it. Most likely the cost is going to be about 25% higher than a single family home, particularly for the 220s that you're going to have to run home runs to the box.
Interesting. Okay, thank you for that.
If you want to see an example of that, if you go to freedompathrealty.com and you go to vacancies, go right now, and I'm just thinking on top of my head, there's an address called 916 North Gaylor Street. And that is a conversion that we did from a single home to a duplex. 1 unit is 900 square foot, 2-1, and it rents for $900. And then the other one is 1,100 square foot, and it rents for $1,200.
I put those links in the chat box to the freedompathrealty.com.
Perfect. Thank you, Aldo. Yeah, I'm going to check that out. I appreciate that.
Perfect. No problem. And for multifamily, man, put that rehab in there. Just have to manage how much you want in your loan against your cash flow. Because obviously the less money you put down, your mortgage is going to be higher. But right now, these rates, I mean, it's going to be easy to make it work. So.
And sorry, I've got one more thing, and this is probably a question that's on everyone's mind right now. How do you go about finding your deals these days? Are you like, is it pocket listings? Is it LoopNet? Are you buying anything from the MLS? Like, what does that look like in 2021? You buying deals?
Um, I am buying, and I'm always looking, but the biggest resource are gonna be, I mean, realtors. I have like maybe 10 realtors that I work with, and you just put yourself out there and say, hey, I'm ready to buy, right? I mean, and particularly in single in these deals, what you gotta be sure that you have is that you're ready to put an offer. I mean, there's no hesitation in this deal. And again, if you have a chance to listen to our podcast, uh, I explained a little bit in detail how we've bought maybe 95% of our properties we have bought without seeing them. And the reason why is the market is so competitive that you gotta be able to make the offer, get into the option period, and then go and evaluate if that property is gonna make you money. And so be ready to make offers. Have your pre-approval letter, have your 2 bank statements, have your funds um, backing, and then just send it and make sure that the realtors understand that you're an investor, because you don't want to waste anybody's time, right? I mean, I've talked to Matt multiple times and I said, hey, I'm gonna make this offer. You want to work on this or not? If he's busy and his time, like, no man, I don't want to, you're not gonna get it. Fine, we go to the next one. Because the fact is, it's got to work for the realtor as well. And if they're putting if you go to a realtor that is listing a $2 million home and you want to buy $100,000 home, I mean, there's going to be a lot of realtors that you're going to be on a second tier, right? Then we also look at LoopNet. We go to the county to look for properties in tax issues, and then we just follow the market. But it is tough. Right now it is not. We're trying to talk to other investors, because right now what we're looking at is to buy 10 or 15 properties in the same block. That's how tough the market is. So people don't want to sell one duplex. They want to sell 29. They want to send 15. And what I can tell you for that, if you get that opportunity, give us a call. Get with somebody. Don't lose it. Don't get intimidated by it either. Just call to the realtor. Probably the realtor has 2 or 3 investors that are ready to buy with you. And maybe you guys can split the property, can get in a partnership, can get and buy different options or whatever it is to make it work.
Good questions, Connor.
Hey, thank you for all that, Aldo.
Thank you, Connor.
Aldo, what do you think about like investing out of state?
Going a little bit back to the decision process. Like, do I let someone manage my properties or do I manage my properties? Right. I think that's just a personal feeling. There's a lot of people that just buy anywhere, anyhow. Right. They can even buy out of the country. I have a friend that is offering me an apartment in Tulum. Right. Like, oh, Airbnb, man, that's the way to go. I mean, it all makes money. You just need to know how to do it. So,
right.
The problem with the out of state and following a little bit the rule of thumb that we were taught, that I believe in, is that if you walk into a property that you don't want to walk into it, the neighborhood, the distance, the condition, if you don't want to do that, most likely your property manager doesn't either. And probably the tenants that you have to deal with are not the ideal ones. So it's a little bit insensitive. Now, needless to say, I do believe in passive investing. So if right now someone in Nashville tells me, hey, I have a multifamily I'm going to flip. I'm going to do this. Let's go in and let's leverage loans. And um, a lot of the banks that are lending very good money and good credits right now are local. I mean, there's like 4 banks in Baytown. Any given day, they give you money for Baytown. Rosenberg, Hempstead. So if you want to leverage those relationships, you might have to invest a little bit more time, but that might be necessary. One thing that a lot of people ask me that I give in my 2 cents as well is on flips. Do I want to continue to flip houses? Right? You sold one of mine a few years back. What I have found is for flips, the best way to go at a flip is if either you're a realtor or you're a general contractor, because the sensitivity on that risk is pretty high. If you buy a house and you estimated a rehab and you go 10% over budget, in the sales price, the market adjusts maybe 5%, maybe you work six months for free. You know what I mean? Because after the capital gain, the 6% on the realtor and the time on the sell, the market, I mean, you did the work for almost nothing. Now, if you're a contractor and a realtor and you can capture 3% on the buy, 3% on the sell, and maybe 5 to 10% on the construction, well, I mean, it almost keeps adding up, right? And if the budget on the rehab goes up, it's going to be less if you're the general contractor, and also adjusts if the price goes lower on the market. No, again, I'm not saying you cannot make money. You can obviously make money. It's just how where you get your resources at, right? So flipping is a little bit more sensitive of those changes on market. Mm-hmm. Renting any given day. I mean, the worst thing that could happen that instead of making 20% 1 year, you make 5, 6. Well, big deal, you know. 10 years, you still make 60% back, but and you pay 50% of the 30% of your capital and on your principal on the loan. So I mean, it's still a pretty good deal, but flips are a little bit more sensitive.
Yeah.
I'm started to look at other things in state, but outside of Houston, and that's gonna take. They gotta just the math needs to work. You gotta put there your inefficiencies. You gotta put that if a plumber charges $100 for a dishwasher, is gonna be $150, and you're gonna have that instead of paying yourself 5% on property management, you're gonna do 15, 10, and then if the numbers make sense, go for it. What we're struggling right now is because, I mean, the math makes sense because the loans are so low.
Right.
So I mean, you can overpay it in some of the services, but the loans are low. We just refi all the portfolio we had last year with a credit union out of Austin, and they gave us 4%, 10 years. Fixed, 30 years amortization with 80% LTV. So we're like, done. Everything.
You gave them all of them.
We made 2 big packages, and we gave all of them. And that relieves us. My credit score went the next month, right? They remove all of my credits, everything for 10 years. For the first time, I had like 2 accounts. And we pulled a bunch of equity out, and then we started buying to Bancorp South, and those guys are lending. I mean, like crazy. They cannot get enough. They bought Icon Bank, so they're all over. Years ago. Yeah, and they're just one in commercial loans. We had used Independent Bank, and Icon Bank disappeared, but Independent, Allegiance, and Bancorp South, and then locally a couple more banks over there in Baytown. And I mean, leveraging. So if the numbers work, go for it. I'm sure there's some good spots right now in the nation that we can get some properties. Yeah. The new trend now as well is Airbnbs. No one knew about it, right? I mean, who would imagine? I had 1, and I now regret. I wish I would have 5, 10, because after the COVID started, I got like 50% cancellation. I mean, everything that was in the books collapsed, and I'm like, oh my god, what's gonna happen?
Right.
And this is a house here. I mean,
4
very
months
close
later,
to
it went right back up.
went right back up, like to maybe 50% more occupancy and a double the price, because those are smart rates or whatever they call it. So the more demand you have, the higher the justice. So now we were renting like $350 a night, and now it's renting for $550, $500. And now it's my wife asking me, well, when are we going? Like, I want to go. Like, can you get me a weekend there? You know. So
where's your Airbnb?
If I would have known.
Where's it located? Your Airbnb.
It's right here in the San Jacinto River, in Channelview. There's a
interesting.
There's a little entrance in between the refineries, between 90 and I-10. It goes like this, and it's a little empty right here. It's also in our website in the portfolio there. And we bought it because I wanted something for the kids to go on the weekends, and we bought it flooded in Harvey. That thing, I mean, it came up like 15 feet. It's on piers on the second floor, everything built maybe 12 feet over seawater. And we remodeled the whole thing. We made it 5 bedrooms, 4 bathrooms. It's right on the river. We have a boat landing with a deck on the top. I mean, and it was just for us. We said, well, we'll put it on Airbnb to see if it rents. And it started to rent pretty good. And that deal was from a friend of mine that has 3 in the same street. He's like, I see the future here. And I'm like, I don't think so. I'm like, I don't see any future here. It was completely mud everywhere, side to side, you know? And I wish now I would have another 4. That would have made my day. Yeah. But now it's the new thing. I mean, people are looking at Airbnbs. No one wants to go to the hotels anymore. No one wants to get on the planes until the volume, I guess, of flights, the frequency gets back to normal. So people are just paying $500-$600 a night, and it's kind of worth it, because if one airplane is $500, then you can split it around the weekend. You drive to Austin or anywhere. Have you guys tried lately to go to Austin, to Lake Travis or so? There's nothing under $800, you know.
Yeah.
Maybe it has water now, but I don't know. Yeah.
How do you manage that? Does your property manager for your main portfolio manage the Airbnb, or is it separate?
My wife. Mainly
cool.
my wife. Yeah, we hired a service of a company called Evolve, and they are a booking and schedule company. And Evolve takes the pictures, puts the description, and then they put it in all across all the platforms, anywhere from Airbnb, HomeAway, Booking.com, I don't know, VRBO, all of them. And then you make a reservation there, and it gets blocked across, and then they take 10% of that fee. But they take the fee. They charge. You don't do absolutely anything. I mean, they get all the calls, all the questions, everything until the tenant gets to their house. Then it's just responsibility, and that makes it great, because then you have to deal with one tenant or 2 tenants just once they get there. So you don't have to answer all these phone calls for, is the coffee maker there? Is it far from the NASA or no? Is the pool going to be cold or hot? Like all those hundreds of calls, they take them. And the other thing is they have a huge, like $1 million liability insurance and protection for the house. So that's a huge deal. I mean, if they break a door, I call, I replace the door, send me the bill, $500, they pay me next day. So that makes a huge difference, because that's what we're all afraid, right? I mean, what if they have a big party and destroy it? What if they destroy it and they lose the keys and I have to call this Kismet? Or, I mean, anything that happens to the property, they cover under their insurance. So You still have your property insurance for the house, but they take care of all the short-term deal, which is pretty good.
What's the breakdown of tenants that you're getting for that for the Airbnb? Because I have some buddies that are in that space, and they've been seeing a lot of people like coming in renting for a month or two. You know, they're in town for contract positions, you know, as opposed to, you know, just families coming in for weekends. I'm just curious, like what you're seeing out in Channel View.
Over there, because we're on the river, we have a lot of locals going for the weekend away. I mean, it's an hour away. I mean, it's super close. So people just like, I want to get out. I just want to see a different scenery, and they rent it. Now, there's a sensitivity there that you have to work with, because you want to be able to make money. So you cannot go super expensive, but you don't want to be the cheapest either. I mean, I have a friend that bought a house from my other friend and rented an Airbnb. Same thing, did exactly the same as, and he has had like 3 parties that destroyed the house. I mean, I'm talking police, arrested, coke, and everything that you can imagine. And he's like, oh my God, I'm super bad luck. And I'm like, no, it's not bad luck. It's that you're renting it for $280 a night. If you rent any house for under $300 for 12 adults, you're going to have a party. It's cheaper than going to dinner that night.
Yeah, that's a great
he's
point.
like, oh, but Evolve doesn't want to change it. They said if I put over $400 that I'm not going to rent. And I said, who cares?
Try it.
Yes, keep it. Like, and we changed our strategy. I called my friend that has 3 houses in the same, and I told him we'll put it in minimum. I think the night we had is $380 minimum a night, $385. The 3 houses minimum, and 3 nights. That's the other thing that you have to do. I remember now. You don't do a 2-night minimum, because 2-night minimums allows to have Friday and Saturday in your house, and that's perfect for parties, right? I mean, $300, 15 people. That's $10 a person per night. I mean, how can you beat it, right? So you don't want that. You want it to be expensive. You want it to, well, if one weekend didn't sell, I didn't sell it. Screw it. I go, and if it didn't rent, I'll go and use it myself. You know. But that's a big mistake. A lot of people do. Just, I want to rent it. I go cheap. I don't know. I don't think you want to. Now you have the insurance though. Anything that is lost, you get back, but it's a lot of work. I mean, you have to still do the work yourself. Send the contractor, fix it, make the claim, and all that.
And since having that, every month, have you either broken even or turned a profit?
Oh, I mean, we're making a killer right now. I mean, you can go. I mean, look it up. Evolve. The address, the zip code is 77049, and it's Rio Villa, RIOWILLA. And right now we're probably netting about $5,000 a month. And it's an expensive house. It's 2,400 square foot. I bought it for $130, and then I put $120, so I end up like $300,000, and then I refi. I pull basically all my money out. If at a price for like $360, so I have it with no money, and I mean, a mortgage right now, what is it, like maybe $2,400 a month, and plus everything else, and it's maybe grossing $6,000 to $7,000 a month. It's crazy. That's very unique, but I hear the same from people from Galveston. I mean, people that bought. You try to buy a house right now in Galveston and see how it goes. I mean,
we tried that.
You guys are 3 years too late. Buy it after Harvey, then I believe it. Now,
didn't want to say anything. Yeah, I know.
No, Galveston, the prices for the Airbnbs went up like 50%. And because of the construction in Houston being so expensive, even if you say, no, I'm going to go long term, I'm going to buy a property and build it myself and be able to be, I mean, there's no one that wants to build it for you for less than maybe $200 a square foot.
Yeah.
So
And then,
easy.
what's your flood insurance like in Channelview? Because that was the issue that I had in Galveston. Like the flood insurance like boxed me out a lot of the deals. And some of the properties it was like 12 grand a year.
12 grand. Yeah, that's what I got. I think. Oh, no, not 12 grand. No, I'm sorry. So I started with 6,000 a year.
Okay.
And then I fought it, I mean, greatly. And then I went and installed, on the first floor, I had walls, brick walls, and then I had to do flood vents. I opened the doors. I had to justify. I went and got an elevated certificate. I went and checked the curves for the 100 years, and then I went and fought it, and it went down to like 1,200. But it took me a year. It's like,
Okay.
I mean, it's a $5,000 a year fight, and I think it's worth it. But in Galveston, I mean, just like Corpus and anything on the Gulf Stream, I mean, all you gotta do is put it back in the price because people are willing to pay it. But again, my philosophy is you make money on the purchase. I mean, I know it sounds a little bit counterintuitive because people wants to believe that the prices are going to increase and the inflation, and then there's going to be some kind of equity and unrealized capital, and it's going to go up. It's going to go up. Well, if it's not a deal there, don't buy it. There's a lot of theory on that, right? I mean, if you don't think it's a good deal with the numbers you're going to work, then rent it. Then just go and buy another. Instead of investing $500,000 on a Galveston that you're going to make at 10%, go and buy 20 other single family homes in Houston and pay the one that is going to rent and you're going to use for maybe one weekend out of the month, and go and get the most expensive in Galveston every weekend you go. Because why would you, I mean, force yourself to go to Galveston every time? And I just don't think it's worth it.
Yeah.
You have to make money to buy. Be ready to buy though. I don't know if are you buying cash or are you buying hard money?
Both cash. So I have private money, and then also I'm similar to you. I have the W-2, so I work in the medical field full time. So I do my best to look good on paper. I'm about to max out with the traditional loans I can get, but yeah, I have private money ready to go.
Yeah, then start looking for small banks. Moody Banks in Galveston is good. Bancorp South is going crazy. If you one thing that you can do, if you're going to max out conventional, means that you're going to get close to the 10 properties. So contact A Plus Credit Union out of Austin.
Okay.
This is the terms that I was telling you. That's the ones that they gave us, and it's nothing better. I mean, anyone that it's telling us right now. We bought a deal with Bancorp South last year. 13 duplexes in Eagle Lake, Texas, in one street. 13 of them. We just bought them, and we're gonna refi with A Plus this year because it's fixed for 10, and it's amortized to 30, 80% LTV. And at the prices that are now, we're probably gonna pull all the money out that we put in. At the same amount, we'll probably make the same amount of money every month. So just keep leveraging. If you do that, then you're gonna have another 10, because these are commercial loans now. They're gonna put it all in one. It's gonna take time. That's the only problem, because they're gonna have to go do appraisals and do all that. But then you're gonna have another 10 conventionals right away.
Perfect. Okay, there we go. I'm gonna reach out to them. Thank you.
Hey, no problem, man.
What about,
all right.
What about do you do any HELOCs, or you just?
Yeah, I have two, and super good idea to have them ready. I mean,
how does is on your primary, or do you have a non-owner occupied HELOC?
I have a one non-owner occupied. That was, I maybe bought it for like 60 grand, and it's like worth like 160 right now. So I go and get a HELOC for 100, and then on my primary, I pull home equity line of credit, and as a HELOC, and just leave it there. And they're super low right now. I mean, they're like 4.5.
Who did your non-owner occupied HELOC?
Independent. Independent bank. Mm-hmm.
Did you have a relationship with them prior, or was that your first transaction?
No, I did have before, but you can open like a little checkings with a little bit of money there. The only tricky part with the HELOCs is that you're gonna have to renew every year, right? Mm-hmm. So you just have to make sure that you do keep track of what they're gonna ask you and all that. But it's a great tool. I mean, I could buy independent bank.
They're here in Houston?
Yep. Yeah. They're all over.
Okay. Oh, okay. Oh, they're okay.
Yeah. Those guys, again, I mean, a HELOC normal is going to lend you anything from 50 to 60% top of the value of the property, but you don't pay anything until you pull the money out. You don't have to pull it all out. You only pay for what you got, and it's available within hours if you want to. So if you have a deal and at the end you need another extra 20, 30 grand, get it done. And then you pay it and it's amortized on that time. It's interest only as well. So that's very good money for rehab as well. You can go get the money, get it in, buy it, use it, and then rehab, put it back, and then done. And then just keep using it over and over. A lot cheaper than doing 2 closings. A lot cheaper. Yeah. That's free money. Well, it's not free money. It's leverage money from a property you own. So
totally. Well, I have some calls to make tomorrow then.
Anytime.
I told you, man, this is gonna be good.
Yeah. I'm gonna ask you, do me a favor and subscribe to the podcast, because we're gonna be giving some info there as well, and some of these discussions that we're having as well is some private investors that are looking for people that are investors that, again, they're saying, hey, I have money I just want to put in, and some of that private money is going to come from people that we're going to be posting, hey, this guy has $1 million and wants 3%, 4%, and link to credit. And then people like you that are already right there in the 10, they're going to have to do that jump for the multifamily. You got to do it. And the other thing to consider is the passive investing on the multifamily. That's a lot of people missing it. I think, Matt, you just bought your first one, right? I mean, that's huge, man. Your learning curve goes like this.
I mean, I got put in on that deal, and it was like due diligence. It's actually out of state, so I mean, there was just all these different things flying at me. I had to go and create another LLC to, protect myself. Hired an attorney to look over the documents that I was signing as a second pair of eyes. I mean, it was just bam, 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 super fast. The one advantage I had was being friends with one of the other guys that's a partner. And I helped them create the slide deck for the other investors. So they were actually going to pitch the property to a bunch of other people. And so I helped with the slide deck, saw all the numbers, saw everything that was going on, and was like, hey, I'm your guy.
I'm in.
Yeah, I'm in. And so, between me and the 2 other guys, we had enough capital to just take it down ourselves and not have a bunch of other people in there. So now, the 3 of us own a $1.2 million property that cash flows, and we get quarterly payments, and it's kind of run like yours. We have a software that runs everything. One of the guys in the deal is really good with finances, and that's kind of his background, and so he runs the books and sends us all everything that's going on with it, so we get to see everything in the background. I can go look at what they just paid to trim the tree. I can go look at what debits and credits came in and out of the account right now if I want to. The
tree trimming came in 20% over budget.
The what?
Said the tree trimming just came in 20% over budget, by the way.
Yeah.
Hey, let's work on it.
So it ended up being a really good. Jake's actually the friend and the partner I was talking about. So I mean, it's really been good. So I put in my money, and I have a skill set that may or may not help them, but everybody in the deal has different skills or a different outlook on it. And so it's been really good to bounce things back and forth. And, I'm a little bit more silent in it, but it's still, I put my money in, I'm getting somewhat of an education and learning things that I didn't know, or reinforcing things that I already thought I knew. So there's just a ton of advantages to being able to do that. And I actually like that it's out of state, because you're forced to manage the property in a different way. And you're not there to be tempted to go fix a toilet,
Is it in the Midwest?
Arkansas. Yeah. So super cool deal. I'm waiting on Jake's brokers to find us another one.
Wow. I actually just signed a $2.8 million offer this morning. So cool. We'll see. No response on it yet, but pretty good deal. Actually, phenomenal deal. If they'll accept it.
Let me know. I got more cash. So, I think there's a lot of opportunities. I think we've gone over a ton of great stuff tonight. I put a bunch of really good details in the chat for anybody who wants to pop in there. And as long as everything goes well, I should have a recording of this to be able to send out. So if you want a recording of it, if you want to send me an instant message through the Facebook group, or just shoot me an email, I'll get that to you. If you want Aldo's information, you can shoot me an email as well, or feel free to give your contact information if you want to.
Yeah, just send, and on that email, just ask Matt, or on our website, on our podcast, there is our email as well. And one thing that it's a common denominator along all investors, and I think that is one of the few recommendations that I see all the way across on real estate investors, which is the networking. It's incredible. The value is just incredible, because there's almost like no one that can cover everything at any time. And it sounds kind of stupid, but it is true. Matt might be a very good, again, for those areas in these parts and his listings, and he gets tied up. Well, there might be another 50. Aldo might be good for duplex and so on, but there's people that owns only multifamilies over 300. They have good opportunities. And there's some other people that are just buying. You guys know those guys from We Buy Ugly Houses, right? I mean, they create an empire of buying trash homes that nobody knew and saw. So those networks, I mean, just like this, brings tons of value. I mean, Jay McLaughlin, he's my co-host in the podcast. He's a realtor, and he's always connected with people out of state that is looking at Houston and other communities, and in South Carolina, looking at deals over there and all these other parts. And I mean, networking is just essential, and you just need one, right? I mean, you cannot do 10 multifamilies all over. So like Jake send us a deal, and we close that other deal in Arkansas with Matt. That's it. That's the value for this evening, So this networking is pretty good. We're gonna do a clubhouse club on for Houston real estate as well, because the only other one that it's out there, it's super huge, is like talking about hundreds of millions of dollars investments. But we might want to get in a more regular basis on something like this, Matt, where we just get and host these conversations along for the networking. And because all you need is one or two, and if you keep staggering those, I mean, that's going to happen. We work through all those deals.
Yeah. Cool.
All right.
Well, I think we'll go ahead and call it an evening. Aldo, again, man, thank you for coming on. Thank you for being a good friend.
Thanks for inviting me, man.
Yeah, this was awesome. I know everybody on here got a ton of value for sure, Connor, and and Jake and Jeremy, and I'm sure some of your guests got a ton out of it. Thanks for your co-host for popping in here. This is super fun. I look forward to being on your podcast soon.
We're gonna do it, man.
Yeah.
Everyone is asking what Connor asked, like, where do we find the deals and what's happening with the market? I mean, it's so dynamic. That's a pretty cool thing about this. Sometimes I wish I would be a realtor, man, just to freaking understand what's going on, because every week, every day, just like
always changes. Yeah.
It's blowing my mind. When I think that I maybe kind of understand what's going on in Houston, then everything changes.
Yeah.
So I kind of love that part.
That's the one nice thing about what I'm doing is I tend to see things way before. Because I mean, sometimes we'll close 10 deals in a month, and I mean, like, that's a shitload of data in 30 days to see what's going on with those deals. I mean, literally just in the last 30 or 45 days, we would get 4 to 5, maybe 7 offers on a property. And then you go to the back half of that 30 or 45 days and we're getting 20, 21 offers on the property. So you automatically see that change. Whereas if you're closing one every 6 months, you're not gonna notice that.
You're not gonna just data point. It's too spread out.
Yeah. I mean, right now we've already sold 20 properties this year, and we have another 10 pending. So you're just getting a lot of data, and we don't sell in one tiny little area either. So I'm kind of getting bits and pieces of really good information around the city, and it helps me understand what's a good investment and what's not, right? I mean, it helped me to understand whether or not I should pull the trigger on the deal I'm in with Jake. And the education, like you were talking about in the beginning, is learning, talking to people. Connor, he does a ton of investments. I get to see what he's doing. So even though I'm helping him because I have a ton of knowledge, I still learn from what he's doing, right? And I get to see it. I learn from what you're doing because we've had, a million lunches to go over, what it is. I screwed up and didn't invest in your deal close to Hempstead, but
I just learned a very practical way that you learn a lot more when you're drinking too. So just keep that in mind.
Yeah.
Lunches are okay. Drinking, it's a little bit better. So
yeah. That is true. So, all right. Well,
thank you guys.